Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his love
Here's the Sandman.
over Sandman.
January 2022 has been the worst month for stock and bond markets in a very long time. This past week, after Chairman Powell spoke, we saw the Dow and the S&P get into correction territory. Many market commentators are urging investors to get out. So what should you do? Is this correction over, or is it the beginning of something worse? Good morning. This is Protect Your Assets, and I'm David Hollander. We have a lot to talk about today. Have you seen some of these recent headlines? This came out from the street. January was the worst performance on record for the S&P 500. From MSN, inflation rises by most since 1982. Stocks fall. These headlines should raise a big red flag for anyone who's invested in the stock market, especially if you're retired or getting close to it. But even if you didn't watch TV, even if you didn't listen to the radio or read the newspaper, what do you think will happen with the stock market when inflation is clearly not going away? Is this bull market over? You know what they say, all good things must come to an end. And unfortunately, it looks like this unforeseen event has caused the next major market correction. So the only way you can potentially protect yourself is by taking action now. So stick with me as we talk about inflation and how you must reallocate your stocks and bonds to get in front of it. You can't afford to miss this show. So much to come your way. So stick around. Now let's get started. Well, like we said, the Dow was up slightly this week, 1.3%. S&P up 0.8%. NASDAQ was flat. The 10-year dropped a little, 1.78. We'll talk a little bit about that in a minute. Oil was up to 87.25 a barrel as the tensions with Russia increase. And for the week, we saw it up 2.5%. Year to date, oil's up 16%, while all those others I just mentioned are all down. But the big one that's down right now, and the big one we're going to keep talking about as inflation sticks around, is high PE tech. ARK, you know, the ETF, down 29.9% year to date. That's right, you heard me right. So we're going through what's called right now a tightening tantrum. Remember the taper tantrum of 2013? Well, what we're doing right now is called a tightening tantrum. You can write that down. This is a tantrum that I don't think is going to end until at least the Fed is assuring the markets that they're going to relax a little bit. The problem is that unlike 2013's taper tantrum, the economy has right now an inflation problem. And the Fed right now is under enormous political pressure to rein in inflation. And that means the Fed will allow stocks to fall more before they provide any sort of rhetorical comfort. So think about it this way. The S&P is now trading below expected 22 earnings of 226. And if you multiply that by 20, that's 45.20 on the S&P. And it's getting closer to what I would consider reasonable, which would be 19 times earnings or 42.95. So we do need to watch earnings right now pretty closely. And markets need the 22 expected earnings to stay stable. And we saw some more of that this week. Because if it doesn't, then that's going to be another headwind on stocks, and we could see easily another 5 to 10% fall from where we are right now. So when does it stop? That's the question I keep getting. When's this all going to stop, Mr. Sandman? I can't stand it anymore. Well, in order for that to happen, we need three things. First, we have to see the Fed back off their hawkish tone right now. Their rhetoric's got to change. Second, earnings have to stay strong. Now, we're about a third of the way right now through the earnings seasons on the S&P 500. 33% of companies have reported. And year over year, they're looking pretty good, up about 24%, which is not bad. And so that's got to continue. That rhetoric's got to continue to be strong from these companies. Otherwise, again, just expect more pressure down. Third, and this is the big one, that's why I talked about ARK, tech has to stabilize. And that could happen, but we just need to keep watching it. So I think, again, where you need to be invested, I'm going to get to that in a minute. But I want to talk to you about what Chairman Powell said this week. Now, I am taking a sip of my virtual coffee, so give me a break here. It's delicious. You got to get yourself some of this. I love it. Anyway, Powell this week spoke to us all, and he said a few things that are very important. I think there was a positive tone coming out of this and a negative tone. Clearly, you saw it in the market. That's why the market dropped. But what he was saying, which we've been talking about this entire month. If you've been listening to this show, this market segment, I've been saying this for a month now. The Fed is serious about raising rates, and that's going to continue to put pressure on the market. It's just that simple, and it's going to keep markets volatile, which is what I've been saying all month. But at this point, I don't think it's enough to end the bull market, so that's a good thing. The Fed was positive because it took their worst-case scenario off the table, which was something that we were worried about, which was them doing something called asset sales to shrink their balance sheet. They're not going to do that. Also using balance sheet to slow the economy. They said that they're not going to do that either. But the Fed was negative in that Powell said this. He said that we could expect a 50 basis point hike in March. So previously we were thinking about just a 25 basis point hike and 3 rate hikes, and now we're looking at a 50 in March and potentially 3 to 4 more throughout the year. Now this is where we need to pay attention, because I want to talk to you right now about what I'm watching very closely. And again, it's the 10 to 2 year spread, because when that gets inverted, then we've got a warning sign going off telling us that stocks are most likely going to enter a worse phase and the economy is going to get really bad. We're not seeing it yet. But after the commentary this week, that compression that I've been talking about has gotten closer. In other words, it's getting lower. It's getting closer to inversion. And this past week, we saw the first time we've seen this in a very long time, 62 basis points. As that continues to slow, as it continues to go down, 50 basis points, 40. If it ever gets to lower than that, that's a warning sign. That's a problem. That's an inversion, and that's a big deal. And the reason why that is a big deal and why we have to keep watching that is because it's the only real signal that we have. Now, how do we dissect that? This is where this gets complicated, and I want to try and make it simple for you, because that's my job, is to keep this stuff easy to understand. So at this point, the 10-year Treasury, which is trading right around 1.78, and the 2-year yield are reflecting at the moment what Powell just said, 5 rate hikes potentially. The 2-year right now at a 1.13%. Now, that would make the Fed funds rate, the borrowing rate, between, because we don't know how much they're going to raise yet, 1% and 1.25. Right now we're about 0. So if there's 4 or 5 raises and one of them's a 50 basis point, you could see 125 on the Fed fund rate. And that's being reflected in the market right now. So the short end of the bond market, the 2-year I just talked about, the 1.13, that is reflecting what I just said, that this amount of rates are going to increase throughout the year. What could cause more compression in the 10 to 2-year spread? That's what I'm worried about right now. One candidate is more Fed rate hikes. So let's say that, for instance, they came out and they said, well, we could do 6 times this year or more, which again, it's possible. Then we'd see the 2-year yield rise to 1.5% or higher. That's going to further compress the curve. but I don't think that's likely. Another and more likely candidate that I think is going to compress the curve is this. It's a slowing of growth. And this was interesting. This just happened yesterday. The 5-year Michigan Consumer Sentiment Report. You know, I talk about that once a month. I look at it. It came out yesterday, Friday afternoon. Michigan said that in the next year, there's 2 numbers they report. The 1-year inflation expectation and the 5-year expectation. And if you know the show, you know what I talk about. The 1 year at 4.9%, that's high. But the 5 year is what I really care about because that's looking at the future. And right now it's at 3.1%. It has gone up because last month it was 2.9. But 3.1 is still within a range I can live with. 3.5 is where I start to get concerned. All right. So the more likely candidate that I think is going to happen is growth will slow, and inflation's going to start to pull back. So we've got to really pay attention to that, because if either of those happen, that's going to cause the 10-year Treasury to decline more, which will make that 10 to compression increase. You see what I'm saying? Because you got the 10-year lowering in yield and you got the 2-year rising. And why that would happen would because the Fed just gets it wrong. They don't do it correctly. And that's what happens, and then the market says, "Okay, guys, you missed the opportunity. You've blown it. Now we got a big problem." The market does what it does. So that's where we are right now. I hope I made that clear. And so that's why we've really got to pay attention to that inflation number and keep our eyes on the earnings reports as they keep coming out. So that's where you want to be. Now, given all that I just said, right now what you're saying to myself, well, what should I do? What should I do right now with my money? Because I don't like it going down. And this past week, I talked to a lot of people who had a lot of technology stocks that have gotten slammed. They're down 20, 30, 40% in some cases. And so I'm going to continue to say this. You should avoid means sell. Yeah, sell your high growth, high PE parts of the market. And what you need to think about is where you should be investing. And so I like the recipe that's cooking up right now for the following: core, longer, and medium-term equity allocations to value, stocks with low price-to-earnings multiples, lower volatility sectors, high-quality cyclicals like financials and industrials, inflation-linked sectors like commodities, using days like Monday and Thursday where the market drops to add positions and get out of those high PE tech like right now, because yesterday was a pretty good day. So now's the time to get out of that stuff. But if you have to own tech, because I know a lot of people love it, then Microsoft, Apple, Amazon, Oracle, not bad. But anything else, I don't know. You know, you got to look at that PE, and if anything's greater than a 50, that's a problem. So lighten up on some of those trading positions or pain points right now in your portfolio and look at things like I just mentioned. I also like international right now, and I like EM, which is also known as emerging markets. Gold, well, this week we saw more pressure on that. And I'm still not a fan right now. So I would be careful if you're speculating around in that as a safe haven. Because know this, as rates rise, which you just heard loud and clear, gold's not where you want to be. It's just that simple. All right, when we come back, if you own rental real estate in California, pay attention. It's coming up next. You're listening to the Protect Your Assets Show with David Hollander, the Sandman. We'll be right back.
After midnight, we're gonna let it all hang out.
You can ask the Sandman questions and hear this show Protect Your Assets hands-free anytime on your Amazon Echo smart speaker. Just say, "Alexa, ask Protect Your Assets to play the latest podcast." Find out more at libertygroupllc.com/voice. Now back to Protect Your Assets with David Hollander, the Sandman.
After midnight.
Welcome back. I'm David Hollander, also known as the Sandman, and you're listening to Protect Your Assets this morning. The most recent economic readings show that inflation is at its highest level in 40 years. It's costing more and more to eat, gas up your car, and maintain your lifestyle. So this is now affecting the stock market as we enter correction territory, and the Fed is reacting accordingly. So if you're retired or soon to be retired, this can have a very big impact on you. And so the good news is there's something you can do about it. So today I'm here to help you protect your portfolio and your retirement lifestyle as I share a few ways to inoculate your retirement from inflation. Our guest is getting ready to come on, so I'm going to go ahead and continue with this inflation subject, and we'll get back to protecting your real estate in a minute. So now it's time for one of our fan favorite parts of the show, our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? There's only one man with all the answers, and here he is, David Hollander, the Sandman.
So here's one that they say. They say that in an inflationary environment, you should own tech stocks in your portfolio, particularly if you work for a technology company. So is that always a good idea? No, it's not. Look at what's happened the last 4 weeks. If you had a substantial portion of your net worth in your high PE tech stock, well, what just happened? Well, if you're like some folks we've talked to, you've lost anywhere from 30 to 50% of your net worth, just like that. And you're asking why, and what should you do now? So let's think back. Can you remember back to 2008, 2009, where it seemed like there was no place to hide, and account balances across the board moved down rather quickly over a short period of time? Well, if you were in a high PE tech stock, you just saw that happen over the last few weeks. And right now you're wondering, what do we do? Well, it's hard for anyone to ignore your account balance and employ the hang-in-there mentality when you're close to retirement and you're looking at your tech stocks to support your lifestyle. And if you're going to live off of that nest egg, well, if it just got decimated and now you're wondering how much farther will it go as interest rates continue to rise, well, what should you do? Is it too late? Well, I'm going to ask you a question. Do you have too much money in a tech stock? Well, Rick did. Rick in Kensington reached out to us recently. And Rick said that he's retiring soon, that he currently has 2 years of living expenses in cash. And what he wanted to know is if he should step in and buy more of his company's stock right now, since it's down over 35%. Because they said he should do it. Well, Rick, I don't like that idea, because what you're doing is you're gambling. One stock, and even your company stock, which, by the way, is a local Bay Area company, it subjects you to all the positives and negatives that can happen in a single day. And this last week was a wake-up call to you, and that's why you're asking this question. I understand that. So ask yourself a question. Why did your company get hit so hard this last week? Well, it's true your company has a strong balance sheet, but here's the deal. Your current price-to-earning ratio on your stock is, get this, 65 to 1. And before the correction started in that company stock, it was over 100 to 1. Now, I know no one pays attention to that stuff, but right now what it's saying is it's going to take 65 years of your company's earnings to equal what the stock's trading for today. That's what that says. That's what that means. And so your stock is not at a place yet where a value investor would step in to buy it. Value investors are ones that look for good bargains, good PE ratios. And so if interest rates keep rising, which Guess what? Last Wednesday you heard they were going to, starting potentially in March 15th to be exact. That's not good for your stock, and that will force your stock to go down even more. So the reason your stock right now is getting hit so hard is because as these interest rates rise, it makes it harder for your company to make money because it's costing them more to borrow and pay for that money. So think about that. If that trend continues, which it's likely to, because it's being priced in right now on the 2-year Treasury, we're seeing it rise steadily, then it's tough. It's tough for them to make any money. So it's better for you to buy a basket of different types of stocks, bonds, and alternatives, yes, to smooth out your ride and make sure you have the income you're going to need in your retirement if this lasts longer than 2 years for your company. Moreover, if you have it all in one stock, yes, you can decide that you can sell shares, but your lifestyle could dictate that you have to sell those shares during your retirement because you need the money. And you don't want to have to do that, particularly if it's down even more. And consider the bond market last week. Those who have held high-quality short-term bonds this year have been rewarded because the 10-year has gone from 1.5 to over 1.8. It's pulled back a little bit. But if you needed to liquidate, say, part of your portfolio that was sitting in those sectors, well, you would be in a much better position because you wouldn't have lost over 35%. So the question you have to ask yourself is, what's the price of your share of stock going to be when you need that money to live on? Will you be able to hold off on selling shares in the middle of a downturn if your stock has fallen dramatically even more? And so I'm not saying this morning that you need to have 100% of your assets in a mutual fund or something called asset allocation either, because another big mistake that people make is when you invest your 401k in an asset allocation strategy, sometimes referred to as a PI or a 20/20 fund. This is where you take all your money and you buy one ETF that says it's going to do it all for you. And what they do is they spread your dollars around to a bunch of different asset classes, and they manage that. But the problem with that is the idea of diversification is that it doesn't mitigate all the risk. And you may remember back to 2008, a diversified asset allocation strategy in one particular 20/20 fund, say, didn't avoid the nosedive. So don't confuse the word diversification with the word safe. I have seen people do this too often. Being diversified does not mean you won't lose money or that you're safe. It simply means you are spread around multiple classes and you have reduced your overall exposure to, say, the one stock. But even some of the most diversified asset allocation strategies lost over 20% back in 2008, 2009. So for those investors who couldn't afford it at that time, they had a problem. And that leads me to the next solution, particularly right now when interest rates are rising. One of the best things you can do right now is to decrease your stock exposure and increase alternatives. Short-term fixed income and principal protection is out there. And you need to add that into your portfolio now. So you can sell stocks with high PEs now and buy more short-term bonds, fixed annuities, FIUL, and CDs. By allocating some of your investments into things that generally carry a lot less risk, that could be a good idea, and you'll still make a little bit of a return. Do you know what the worst bear market's been in U.S. history? Well, it was the bear market from September of 1929 to June of 1932. That resulted in an 86.2% loss for the S&P. They say the market always comes back, right? Well, it does. But the question is, how long will it take? You would have had to wait until 1954 just to break even from the bear market that began in 1929. That's 25 years to recover. And that's exactly why people nearing or in retirement need to be more preservation-minded so that a bear market doesn't set them back, especially if you need income from your portfolio. So here's the elephant in the room. How much will the Fed raise interest rates this year, and what will the effect be on your stocks? While it's difficult to predict where the market's going to go next week or the week after that, there are things we can look at now that can help you understand what's likely to occur in your portfolio. The first place I would start is to understand the risk that you have right now. I call this a portfolio MRI. We have a tool to take a snapshot of your portfolio and show you with a 95% probability what can happen in the next 6 months, and more importantly, if there's another major market event, what your downside could be. Wouldn't it be great to have this kind of information at your fingertips right now before it's too late? Of course it would. So what I'm going to do right now for anyone who calls in the next 5 minutes during our break here is I'm going to give you your very own portfolio MRI. This will not cost you a cent, and you can find out with a 95% probability what your portfolio will do over the next 6 months. But in order to get this, you have to call this number, 866-PROTECT. That's 866-PROTECT. You can finally find out what your portfolio is capable of doing before it happens by calling me now, 866-776-8328. Give me a call now. When we come back, hopefully we'll be talking about real estate protection. It's all coming up next, so stick around. We'll be right back.
You can ask the Sandman questions and hear this show Protect Your Assets hands-free anytime on your Amazon Echo smart speaker. Just say, Alexa, ask Protect Your Assets to play the latest podcast. Find out more at libertygroupllc.com/voice. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman, and you're listening to Protect Your Assets on the Protect Your Assets radio network. And you know, the last few years, particularly the build-up towards the end of 21, the stock market has been hot. It's been so hot over the last couple of years that we've seen all-time highs set on the S&P 500, the Dow, the NASDAQ. And then what? Will January 2022 hit? And now all the major indexes, including the bond market, are down, and many people are asking, what should they do now? So a large part of this is frankly due to inflation, and inflation is at its highest level we've seen in 40 years, and that's causing the Fed to take action. And because inflation is so high, the value of your real estate has also increased in value. And in fact, many of you are sitting on assets that right now are worth a fortune when you look at the property. So what's to prevent your tenant from coming after you and trying to take it away from you and your family? After all, this is California, and tenants have rights. So I thought I would take a minute here to take some time to talk to you about things you can do to protect your real estate from these lawsuits that can come out of nowhere. According to a real estate authority who I've been talking to lately, you could have a lawsuit that's a high probability of happening over the life of your property. In fact, according to this expert, it's 95%. 95% of real estate investors are going to face some kind of major lawsuit in their lifetime, and that's a problem, particularly because lawsuits are expensive. So the first thing you have to understand as an owner, if you are sued, is you have to defend yourself. And just the cost of defending yourself could be as high as $200,000, $250,000 just to pay the attorneys to go through the process. Now, you add to that the fact that you're probably carrying insurance on your property, and many people that I meet with have insurance on each piece of property, and that insurance amounts to typically around $1 million. Sometimes people have looked at it closely and they say, I'm worth $3, $4, $5 million, so I better carry an umbrella and get myself more insurance so I make sure that I've got it in case there's a problem. Well, those are good strategies. And of course, remember that the legal fees that I just mentioned are going to be part of that $1 million or that $3 or $4 or $5 million umbrella that you have. Those legal fees come out of that amount of liability insurance that you're carrying. And whatever's left is what gets paid to the plaintiff if he or she is successful. Now, the other thing you have to think about is what if they hit you or you get stuck with a larger verdict or award than your insurance policy can handle, and you've got other assets like a house or a bank account. Well, then you've got a problem. And you should think about setting up some sort of asset protection strategy to protect yourself from that happening. So I'm sure you've heard about LLCs, and one of the ways you could protect yourself is doing what's called a series of LLCs. And that's better than a traditional LLC because of the following reason. If you have a property or multiple properties and you have a single LLC entity that owns those properties and you treat it like a business, the revenue flows into the company, goes out of the company, you pay your expenses, and whatever's left, you do a distribution on your tax return to yourself as the net cash flow. Well, that's a great strategy. And by the way, if you do that and you're positive and you have money that you're not spending, you should talk to us because I can show you how to stick that away and not pay taxes on it until you're 72 or older. Yes, you heard me right. But the other thing I'm saying is that if you have a single LLC owning all these properties, well, what's to prevent the tenant in your apartment building not getting the apartment building in a lawsuit and then also getting the commercial building or storage facility that you have in that same LLC? Well, nothing. Because if they stick you for an award that's bigger than the value of that property, even in today's inflated values, they can still come after you. They can still come after those other assets and get the full amount of what they win against you. So the question is, you have to do a benefit analysis here. You have to look at the value of the property. You have to look at your net worth. And you have to decide, is it worth setting up a series of LLCs? In other words, you have a LLC that holds your storage. You have an LLC that holds your commercial. You have an LLC that holds your apartment buildings, etc. You break them up into individual pieces. So not only are you diversifying your real estate exposure and holdings, because as you know, as we just went through this pandemic, some things like storage did pretty well, whereas some things like commercial didn't do so well because people weren't going to work anymore and businesses were falling right and left, and then you lose income. So you still get the tax benefits of the depreciation. You still have the structure and protection of an LLC by setting up an LLC. But the question you really have to think about is, does it make sense to have multiple LLCs? And again, you want to have the owners of those LLCs not reflect your name or your family's name. You want to have them sort of be innocuous so they don't really make any sense to anybody who's looking for you. Follow me? So these are things you can do to protect your real estate. Now, what is my outlook on real estate for 2022? It's been a pretty good run. We've seen a very good run. And as inflation hangs around here, real estate's not a bad asset to be hiding out in, and a lot of people have done it. And that's why you've seen the values go much higher. But think about this. As rates rise, which Chairman Powell just said last Wednesday, they're going to, the value of your real estate will most likely cycle and will most likely drop. And that's because it will be more expensive for people to pay these outrageous prices because they can't afford the financing. So as those rates rise, particularly adjustable loans, those folks who have leverage are going to get in trouble. And they're going to have to sell off these assets in order to pay their bills. And that's where the opportunities lie in real estate. So if you're at the moment thinking about now might be a good time to sell it, maybe do a 1031 exchange into some other property so you delay that or swap. They call it swap till you drop. Keep swapping that gain forever until you pass away, and then your kids receive a step-up in basis under the current tax law. So they're in good shape. Good way to do it. I talk a lot about Prop 19, so you need to address that issue as well. But all these things can be handled. And so if you own real estate, you should give us a call. We are attorneys. We are tax CPAs in our office. We do real estate for a living. We love real estate. And so we would encourage you to give us a call and talk through what you're going through, what you're experiencing, and what could happen if you get sued. I know you love your tenants. You may have some great tenants. But at some point, they could see how much your property's worth, and they may say, you don't deserve that. Or, maybe I should get a shot at that. Maybe so-and-so give me a couple $100,000. These things happen all the time. And it's terrible. It's hard. So if you want to talk more about this confidentially, remember, we are attorneys. We can have the attorney-client privilege. You need to pick up the phone and dial this number, 866-PROTECT, where you can schedule a call with an attorney. And we'll do that right now, confidentially. And complimentary. We'll give you a half hour complimentary with an attorney if you call right now, but it's only going to be good for this break, and then my hourly comes back. So it's 866-PROTECT if you have real estate, if you've thought about protecting that real estate from lawsuits or from problems that can arise. Again, we've seen hundreds of situations, and we'd be more than happy to share those with you and help you protect yourself. So hopefully this doesn't happen. Now we're going to take a quick break, and when we come back, when inflation rears its ugly head, which it's doing right now, you're seeing the effects of that in the market right now. There are certain investments that you want to own and others you definitely don't want to own. Find out what those are. I'm going to talk to you about that next. It's all coming up next, so stick around.
You can ask the Sandman questions and hear this show Protect Your Assets hands-free anytime on your Amazon Echo smart speaker. Just say, Alexa, ask Protect Your Assets to play the latest podcast. Find out more at libertygroupllc.com/voice. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman, and you're listening to Protect Your Assets this morning. And isn't that name right now so relevant when we're seeing markets drop like they did this past week, and we see inflation running at a 40-year high? We all knew it. We all knew at some point Humpty Dumpty was going to fall off the wall, and now I'm helping you pick up all the pieces. And that reminds me, if you missed any of our show today, and most importantly, my market segment this morning where I was talking about the S&P 500 and what I expected for this year and where you should be hiding out, then go listen to our podcast. And the way you will find that is if you have Spotify or iTunes, just type in Protect Your Assets and you'll find it right there. Now, if you like what you hear, there is a star rating there, and I would really appreciate a 5-star, and that would be great. So if you like it, please take care of that for me and tell a friend. Like to wish some happy birthdays. David Kawayoshi, the big 70, happy birthday. Felice Stahl, Lily Lawrence, Tony Martinez, Jane Valancourt, Mark Gersh, and Janet Landels. Happy birthday to all of you guys. I hope you have a great birthday. And when inflation rears its ugly head like it's doing right now, there are definitely certain investments that you want to own and others you definitely want to avoid. So earlier in my market segment, I covered those that you want to own, but the question is, what should you be transitioning into right now? And I'm going to ask you a question. What do you know about alternatives? A surefire way to reduce your market risk and protect yourself and your income right now is to create a pension, a stream of income. And a good way to do that is by using fixed annuities. You're hearing me say that, fixed annuities. By taking and positioning a portion of your portfolio, even the most risky one that you're very concerned about and it's dropping, to create a income stream that is protected and insured by a high-grade insurance company, can help you pay your bills monthly during retirement so you can live the lifestyle that you've always been dreaming about. And these checks come each and every month, just like a pension that you may or may not have. Because if you know anything about pensions, most companies will take the money that you've been saving and they'll buy an annuity, just like what I'm talking about, which is a pension. It's the same thing. So right now, if you're 65 years old and you're looking for income right now, we have something that's paying 5.7% in income right now. And depending on your age, that could be higher. If you're younger, it could be lower. But it's a lot better than putting it in the bank and earning nothing. Another approach I like to use is using different buckets. So you assign a specific objective to each bucket of your portfolio. You can have a bucket that takes care of your income, like I just talked about. You can allocate another amount of your money into a growth bucket for those exciting stocks you want to own and let them do their ups and downs without having to sell them when you need the money to pay your bills. You can use those to buy stocks like value right now, cyclicals that pay dividends, or yes, mega cap technology. I talked about that in the beginning, the ones I like that have lower PEs, strong dividends, good balance sheets. And I would also recommend allocating part of your money into an income bucket that is safe and liquid and available that you have. So if something gets very good value, say, you have the money to jump in and cash in and buy it because the money's liquid. So that's important. And you should also consider how much in taxes you're paying on all of this income, because taxes, once again, could affect you. So you may want to look at tax freeze. Now, another thing you want to think about is what should you do with your portfolio right now? And right now, it is tough to stay on top of this. I understand it. You think your portfolio is diversified, but then you had a week happen like we just saw. And the truth is, it doesn't have to be complex. It doesn't have to be confusing. You can lower the volatility by just understanding what kind of risk is in your portfolio. And we have the tools which can identify specifically how much risk you're facing, how much money you could lose here with a 95% probability in the next 6 months. And as I was talking about our caller who called in earlier, he didn't have any idea of what was going to happen until he lost 30% of his stock this past week. And now he was wondering what he could do to stop the bleeding because he wants to retire soon. And so if you're like him, pick up the phone now and give us a call to help us help you align your portfolio to your goals, which could be retiring in May. Think about it. If you're in your 50s, you're probably going to live another 40 years. Don't you think spending 15 minutes of your time is worth 40 years of peace of mind? Of course it is. So call me right now and set up a 15-minute coaching call or an in-person meeting. We do serve Ritual Coffee, which is made right here in the Bay Area, which in my opinion is some of the best coffee in the area. We have free parking. We have a friendly staff to greet you when you arrive. And best of all, we are local. So give us a call now and find out how we can show you to shore up and make your portfolio retirement ready. Call this number, 866-PROTECT. Again, 866-PROTECT. Protect yourself and your family right now. What are you waiting for? Dial this number, 866-PROTECT. I'd like to give a big thanks to the Protect Your Assets team for putting together another great show today, because without my team, I'm just another pretty voice on the radio. Thanks again, everybody. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
All calls have been screened. Callers should not expect their conversations with David Hollander on the radio or with staff to be held in confidence. And that legal information provided on the air is not intended to be a substitute for callers hiring their own lawyers to advise them about personal legal matters. Proper advice depends on complete analysis of all the facts and circumstances. The information given on this program is in the nature of general financial comment and cannot be relied upon as pertaining to your specific financial situation. California Life Agent number 0B48569. Listeners should consult their own financial advisor or conduct their own due diligence before making any financial decisions. The preceding program was paid for by Liberty Group, LLC. The views and the opinions of the host do not represent those of this station or its ownership. You're listening to the Protect Your Assets Radio Network.